By Dan Genter, CEO and CIO of Genter Capital Management. Dan, thank you so much for joining us today. All right, you describe the 2025 setup as having plenty of wind at our backs. You point out strong employment, AI investment. What's the most underappreciated tailwind right now from your point of view?
Well, look, I think that you have a situation to where there's just going to be strong capex that's going to be invested in the country. I mean, the president is looking to bring domestic production back much stronger. You're going to see investment of that. You're going to see tax breaks and credits to make that happen. And I think overall, when you look at the little bit of the headwinds that we might have, they're definitely overwhelmed by the tailwinds in that regard. I think in addition, look, we're probably going to see at least 2 rate cuts going into the latter part of the year. And that's really kind of the only thing holding us back. The high rates are, definitely have been a little bit of ceiling on growth. But once we can do that, recapitalize some of the real estate, take a little pressure off the consumer, make loans a little more affordable for capex expansion, then I think that we're in a good situation, at least for moderate growth for the foreseeable future.
And you point that out, the higher for longer interest rates as the bear poking risk factor. Here, you mentioned S&P 500 earnings estimates for 2025 might be too optimistic. If we land closer to your view, what does that mean for valuations at current index levels?
Well, I think what's happening is at a 21 PE that you can maintain that. I think it's going to make it very difficult to expand PEs. So if we come in closer to our estimates, closer to about, up about 9%, I think you can maintain the PEs and you can track earnings. But then going into 26, probably seeing about 6%. So I think it puts a little bit of a lid on the market. We maintain this unless we see a larger than expected reduction in interest rates. And then we track earnings, so that still puts us in somewhere, 8, 9% market environment from here, which is very strong. And
Okay. And again, I want to go into the tailwinds because we had a few pieces of economic data, hard economic data points, because often there are those who point out that we were waiting for the hard data to show up. Jobless claims came in better than expected. Retail sales actually came in much better than expected, up 0.6%. The expectation was up 0.1%, and that doesn't even include a prime. Philly Fed also coming in better than expected, showing growth there, actually. What's your take on that? Do you think that's a one-off?
No, I don't, because I think the strong tailwind that you have here is employment. Employment's going to drive everything. As long as we stay at full employment and where we are now, then obviously the consumer is going to stay flush. The consumer is going to be confident. The consumer is going to continue to spend. And we're not seeing really a break in that. I mean, the only break you're seeing is that people aren't quite as confident leaving their jobs, that it's taking a little longer basically to find a replacement job. But other than that, the job market is very, very strong. And the fact of the matter is we have never had a recession when we've had a strong job market.
Okay. And then, Dan, I know you've got a few stock picks. We won't get to all of them, but let's talk about Coterra Energy. That has underperformed the S&P 500 year to date. Why do you like it?
Well, we like it because they're the lowest cost producer in the natural gas space. Natural gas space is actually getting a very strong bid right now. They have great properties in the Marcellus and Permian Basin. They're, as I mentioned, they're the lowest cost producer, and they can switch back and forth between oil and gas because of where their properties are. And so we think as you start to get a little more bid behind the natural gas, that they're significantly undervalued and actually have, probably a good 40% of upside in their stock from where they are now at a relatively reasonable PE, and you get a 3.4% dividend while you wait.
Who doesn't like a dividend there?
Yeah.
All right, let's talk about another one on your list. You've got LKQ on your list. It's alternative vehicle replacement parts. Also underperformed the S&P 500. Why do you think there's an opportunity there now?
Well, they've gone through the whole industry is going through a little bit of a soft stretch, mainly because the good thing is collision rates are down. We had a mild winter across the U.S. They just had fewer accidents. We think that that's temporary, and as it picks up, they have a very strong market share. 30,000 trucks, 5,000 trucks for the 30,000 body shops that they support, and they're in a position to where their replacement parts are about 50% below what you pay for manufacturers' parts, and so they're at a low PE right now and at a low spot. So we think it's just a good place to buy in, and literally have very significant upside from where they are now.
Okay, one more on your list. We are getting to all yours on your list. I didn't think we had enough time, but you're rocking. Let's talk about CRH, Building Materials and Products Company. Tell us your views on where this goes from here this year.
Kind of boring with what they do. It's literally basic materials for a building, but they're in a prime position. They're one of the largest in the world. They're selling at a 30% discount to Vulcan Materials and Martin Marietta, which are their U.S. counterparts. And so they're just in a perfect position for build out of, what we see in U.S. infrastructure. And so we think that, again, again, very undervalued right now. Valuation play with quite a bit of upside, as the economy begins to expand.
Okay, and I want to get a quick final thought from you on the Fed. That's been kind of top of mind right now, given the conversation that we've heard. The president has said he's not planning to fire Powell, but what's your thought on just all the rhetoric around his role?
Well, look, he's in a tough spot right now. I think he's really trying to operate with the numbers and to respond to those numbers. But the president clearly sees that, that the interest rates higher for longer is not good for the expanding economy. So we have a tug of war that is an obvious, rather, tug of war. But I think the numbers are going to come through, as I mentioned earlier. And we're not going to see anything in July. It's unlikely, but we may see 25 basis points as we move into the beginning of the fourth quarter, and another one before year end. So hopefully we're 50 basis points lower, and that spurs a number of different sectors.
All right, Dan, we'll have to leave our conversation there for today. Thank you.
All right, my pleasure.
Appreciate it. That's Dan Genter, CEO and CIO of Genter.